afternoon and welcome to today's webinar, which is our corporate finance debate for the Midlands region. In this webinar, we're going to look at the M&A market with a brief overview of 2020 and discuss how we see 2021. For those of you who don't know, my name is Lawrence Underwood. I'm the Recruitment Director for the East and West Midlands for FD Recruit, and I'm joined by two expert panellists who will be sharing their extensive knowledge of working in the CF market. You notice there's two rather than three. Unfortunately, Dan Bowtell, Corporate Finance Partner at Smith Cooper, is not well today, so he won't be joining us, but my thoughts and wishes go out to him. Hopefully it's nothing serious and he gets well soon. The running order for the webinar today will be a brief introduction from the panellists, and then we'll run through a series of pre-prepared questions. Then we'll open up to the questions from the audience. If you would like to ask the panellists any questions, please use the chat box facility on your screens. You'll see that on your screens. Don't use the email as Zoom suggests, because I haven't got access to that. I can see the chat box and keep an eye on that through the presentation. So any of your questions I'll address at the end. So as you feel like it, just write them down and I'll pick them up. I'm now going to switch to gallery view and bring in my guests. The first one is Roy Farmer, Corporate Finance Partner at Dains Accountants, and then we'll go over quickly to Adam Rowlands, Partner at Keystone Partners, for a brief introduction, then we'll get on with the questions. So over to you, Roy. Quick 60 seconds, the floor is yours.
We look after a broad range of owner-managed businesses, and then we have some particular specialisms in charities and academies, and some fairly deep sector specialisms in employment taxes and indirect taxes. But as I say, I look after the corporate finance team, and so in the last 12 months I've been busy working with clients on CBILS applications and some fairly typical transactions, albeit as we'll talk about, the volume of transactions was certainly hit in 2020, and we're still trying to get to grips with what the new normal looks like.
Brilliant, Roy. Thank you so much for your introduction. Second warm welcome to Adam Rowlands, who's Corporate Finance Partner at Keystone Partners. Welcome.
Thank you, Lawrence. Good afternoon, everyone. My name is Adam Rowlands. I'm a partner at Keystone. Keystone is a corporate finance boutique based in Birmingham City Centre. We've got a small team of 6 people. I'm one of 3 partners there, and our core focus is purely corporate finance, so advising owner-managed businesses, private equity firms and banks in the £5 to £50 million deal range across all the transaction types, so looking at buying businesses, selling businesses, company refinancing, and probably something that's a bit unusual that not all CF firms do, which is off-market research and origination. So we are an award-nominated business this year and very much focused on finding good quality businesses to work with and being very active in terms of finding good opportunities that are off market.
Brilliant. Thank you both. And again, warm welcome to both of you. Let's get into the thick of it then, into the questions. First off, Roy, if I can ask you, what have you learned during 2020 that will impact on how you approach M&A activity in 2021?
Well, I suppose we always enter into transaction processes, maybe expecting the unexpected, but I don't think anyone could have predicted what happened in 2020. I cast my mind back to just prior to the budget in March 2020, where we completed 4 transactions on the, I think it was the 9th and 10th of March. And whilst people were talking about coronavirus, the only impact on any of those deals that we were contemplating was a disruption to the supply chain, where we were sourcing from China and Italy. So it shows that 2 weeks later we was in full lockdown. And as I say, in none of those deals did we think to sensitize perhaps a financial model to stress test it in the event of no sales for 3 months, which would have probably been quite a sensible sensitivity with hindsight, but one which none of us could have predicted. So I suppose in answer to your question, what have I learned? I suppose we always look when we enter into transactions, and I'm sure Adam will do the same, to try and find out where the risks are, risks with the transaction, risks with the business, and try and find mitigants to those risks. I suppose learning points from 2020, I just hope we don't have to repeat for another 100 years, given it's been 100 years since the last pandemic of that nature. So I'd say, I think what we're all going to learn, though, is or what we have learned in 2020 is how to work remotely a lot better. I mean, as you can see, I'm sat in my office today in Derby alone. It's about 30 workstations, and it's just because I live local that I've been coming into the office and for this. But I probably was a cynic when it came to working from home and really not using Zoom or Teams. Probably hadn't even heard of Zoom back in March. So I suppose one of the real positives has been flexible working. As a firm, I don't think we're going to see our full workforce back, working 5 days a week in the office. That is certainly not required. And I think that we can translate that to the sort of M&A process, where I cast my mind back to you might have a couple of hours meeting with a couple of hours travel either side. And I think those days for the good are largely gone, albeit I think many of our clients do still welcome that face-to-face relationship as well. So I think it's probably getting the balance right between building relationships, but also being perhaps more sensible with diary planning and being more effective.
Yeah. Adam, do you have anything to add to that? I mean, that's a fairly concise answer, but if you've got anything to add.
Yeah, I think I'd echo everything Roy said. I think you've got to be flexible and adapt. I think there's a lot more people looking now. It's definitely at the forefront of I'm thinking about doing something, and whereby a couple of years ago, someone maybe said, look, I'm happy just for the status quo. They might be sitting on a lot of cash. And I know one of the questions later on is about tax, but that's definitely at the forefront. And I think also just the timing of it, just if you are an owner that is 65, should you be thinking about selling? How much do you value those next 5 years? Do you want to carry on in the business, or are there different options? So rather than just a pure trade sale, are there ways you can do phased exits and take some of that cash out and de-risk with, for example, a private equity deal or some type of debt buyout? So we very much use this as an opportunity to up our origination and speak to businesses up and down the country that are very much thinking about, we want to do something, we're just not sure what we want to do, and being able to present the options available has been quite interesting, especially with Zoom and Teams. We've had a lot more of these type of conversations, and a lot of the CF firms I speak to are promptly very busy at the moment with very much these type of situations. So I think it's just kick-started people to bring to the forefront of, I should be thinking and speaking to people about what are the options are available, because every business is different, every situation is different, but ultimately it comes down to what's the plan and what do I want to do and what options have I got available.
Okay. And Adam, how have you seen deal structures evolve during 2020? Last year obviously was very different. So how has that changed things?
I think for us as a firm, we've completed 8 transactions now over the last 2.5 years, and there's a wide range of both sales but also partial sales. So I think what we're seeing, and I'm sure other CF firms are so echoing this, that there are other options available in terms of phased buyouts or employee ownership trusts or some type of equity release transactions whereby the traditional sale route might not be there. So one of the things we do, and I'm sure Roy and a lot of other good quality CF firms do, will go through a series of qualification questions and qualify, is the business exit ready, and can you go through a transaction and get the best chance of success? And sometimes businesses aren't ready, or they are ready and there's no buyers, and it becomes quite challenging to sell it. So if you are purely focused on selling, that can be quite a limitation sometimes if you're not ready. So I think the key message is that there is flexibility around transactions and there are options available, and we're very much seeing, especially coming out the back of coronavirus, and good quality businesses that are traded through and sitting on lots of cash, they are open to structures to de-risk, and de-risking isn't just selling. Sometimes it is one of 3 or 4 transactions that I've touched on that might work for them.
Roy, anything to add on that?
I think, as Adam said, what I'm hoping 2020 has taught people is that if they haven't got a plan to exit, then they need to have one. And it is amazing how many business owners trade sale is simply the only option. We too have done a number of sort of partial exits where sellers probably aren't ready to physically leave the building now, but they want to over the next 5 years. And you can very tax efficiently structure something, which means that they can, take some cash now, defer some, perhaps take an ongoing equity stake in the company, and then probably phase themselves out over the next few years as their confidence in their management team increases. And those are really nice deal structures where an owner perhaps wants to sell to the management team, but perhaps doesn't really know quite how he or she's going to do that before speaking with an advisor.
Okay. And staying with you, Roy, how do you think potential changes to capital gains tax will impact the M&A market?
So don't hold me to this. I was really certain that entrepreneurs relief was going to change last March, and it did. Lifetime allowance reduced from 10 million to 1 million. About 6 or 8 weeks ago, I was really concerned that tax changes CGT was going to change again at this budget. I'm now thinking it won't be this budget, because my sense is that government just feel that there isn't perhaps the appetite to handle further tax rises at this stage. But I think if it doesn't happen this March, then increasing CGT is on the cards over the next 1 to 2 years. And in many ways, it may, if there is no change, it may fire the starting pistol for a few business owners who say, well, maybe I've got a 12-month window to, create an exit event for myself. So that could actually be pretty good environment for myself and Adam, who thrive off people wanting to do transactions. If capital gains tax rates go up to income tax rates, then I'll have to perhaps decide what else I'm going to be doing, because the 10% entrepreneurs relief allowance and then 20% rate is still very attractive to business owners. If they're going to be paying 40 or 45% rates of tax on their proceeds, a lot of them will just pay dividends to themselves and keep hold of the business, and that's not really great for them, and it's not really great for the business either. So the only other thing I'd say is, and we'll probably talk about it, we will have done 3 sales to employee ownership trusts over a 12-month period, and this is where a business owner sells their company to their employees. And whilst for many business owners that is driven for purely altruistic reasons, if properly structured, it's nil rate capital gains tax. So we're finding, especially now that entrepreneurs relief lifetime allowance has gone from 10 million to 1 million, a lot more business owners are wanting to know more. It's not always right for many businesses, but wanting to know more about the EOT structure. And if CGT rates go up further and the gap widens, I can't help thinking even more business owners will want to explore that route.
Okay.
And Adam, same for you. Anything to add there about capital gains tax changes?
I think so. I think Roy's given a really good view there. I just think it's the uncertainty. You don't know what's going to. I think hopefully they won't change the capital gains tax and align them with income tax. But if they do, I think it'll definitely drive the wrong behaviour, and I can't see why people would sell. But the EOT is a good option if that's the case. But I'm hoping if they do put some tax legislation, most likely next year, they also allow some type of retirement relief, which was available when the tax rates were higher previously. So if someone meets certain conditions, they can dilute the tax, because you've got to try and drive the right behaviour here and get people to invest in businesses and set up businesses and drive businesses, not just tax them to the hill based on the deficit. So it's just trying to find something that's, I think, fair and deliverable.
Yeah,
I think just adding to what Adam said, I think what he said about retirement relief would really soften any capital gains tax increase. So again, if I was Chancellor, and I was going to increase capital gains tax, increase what was entrepreneurs relief allowance maybe to £2, £3, £5 million lifetime allowance. It really does soften it for business owners who are selling for a number of millions of pounds. And certainly from my client base, where we're probably acting for a lot of businesses valued at 2 to 20, it would help an awful lot. So fingers crossed. He's clearly Chancellor's got a lot on his plate, and he's got to find a lot of tax from somewhere. But what we do know is if you hike tax rates up too much, people find a way around it.
Yeah. Now, I suppose no webinar is complete without talk of Brexit. So, yeah. Adam, what do you think the impact of Brexit might have on the M&A market this year?
I think it's a wide question. Obviously, that impacts more sectors than others, but I think ultimately that the key fundamentals always remain the same. If you're looking at a trade buyer, they're going to look at different characteristics to a private equity buyer, or even a debt fund or a bank providing funding on a debt-only buyout. But ultimately, all businesses have to be secure and robust, and generate cash and be able to service debt. So my personal view is I think the market will still be active. All the private equity firms we speak to, all the other advisors we speak to, all the banks, all the alternative debt funders are the busiest they've ever been at the moment. So there's a lot going on. It's just how it impacts individual sectors. So I think that it really comes down to the sectors and people's interest in that sector to do something. But I think as an overview, I'd expect the Brexit will have some impact. Some will be negative, some will be positive. But we're hoping, obviously, that the core remains there and there's still transactions to be done and advisors are getting deals over the line.
Brilliant. Roy, anything to add to that?
I think we've got a number of clients who we delivered pre-Christmas. My indirect tax colleagues delivered a lot of government-funded customs training to clients to help manage the change. But I think what we're finding now is that certain clients are trying to get, they've potentially, where they've got maybe overseas customers, have told overseas customers last year, build up stock because we're not going to ship in January. So we've got January to kind of work out what's going on. So I think we've got clients who are trying to get to grips with the additional paperwork and the like that they need to be able to do business overseas. So I think only time will tell, as we get further into this quarter, as to how businesses are managing. And, I suppose if it's having either a negative effect on the top line or just a negative effect on the bottom line, i.e. they can continue to do business, but perhaps have increased costs through setting up sites in Europe, perhaps, which, again, I think businesses will find a way. It just depends, as I say, how much it impacts top line and bottom line, and then how that would impact on value.
Yeah. And Roy, is now a good time to make acquisitions?
I suppose it depends, and it depends on the sector you're looking at. It depends on the multiples that you think are being commanded for companies. So we've got a number of clients who are actively looking at acquisitions now, and I've got a number of management teams who are looking to buy the businesses that they run. And I suppose I don't actually think the pandemic is really kind of impacting on acquisitions. Will either be right or not. I suppose there'll always be people out there looking to pick up a bargain. But I suppose the clients we're working with are typically looking for strategic acquisitions. And for those acquisitions, it's got to be a right fit. There's got to be a cultural fit. And then I suppose then you move on to the price, that you're going to pay for the business. I think that's quite tricky at the moment because for some clients, they've had an artificially good 2020 due to the pandemic. I can think of some of my clients who have, and I've had others who haven't had such a good time. And I suppose really to properly assess the value of a company, you need to understand what's normal. And I suppose in an ideal world, you'd have 3 or 6 months of normality whenever normality starts again, to see what shape a business has come out of the pandemic in, because I suppose it's wrong to look at it with the shape it was in pre-pandemic, because a lot of businesses have actually changed shape for the better. They've used the opportunity to cut the cost base, become leaner and become fitter. But I know I've got a couple of sales where the results have been artificially inflated, and I know I'm going to be having those discussions with potential buyers. Where they'll say, well, you're not expecting me to pay a multiple of 2020's results, are you? Because there's a good pandemic effect in there. So I suppose it's a tricky it's a tricky time to transact, because for some businesses are still deep in their struggles. For some businesses, they're changing shape, and it's what shape they're going to come out of. I think it's lockdown 3 we're in now. Let's hope it's the last one. But even then, I suppose I saw pre-Christmas, I was mentioning to you, Lawrence, I thought pre-Christmas we'd have a quarter of lockdown this year. But I'm increasingly starting to think that it's going to drift into late spring, early summer. So I suppose it's still a good time to do transactions, but I guess you've got to tread with care, because if it was challenging before to assess whether or not a company was a good or bad one for you to acquire, given I think the stats are probably that 50% of acquisitions don't turn out how you want them, you've just got to put even more effort into thinking it through.
Yeah. Adam, how's that answer feel for you?
Absolutely. I don't think I can really add much more. I think Roy's hit every key point there. Yeah, he's just trying to get to that underlying earnings and getting the information presented in the right way, and trying to take out the dips, whether it be good or bad, and just say, what does core business look like going forward? Because that's what it's going to be most likely based on, outside of any upside on a strategic price. So yeah, no, I think Roy's done a really good summary on that question.
And Adam, for those owners who might be thinking of selling in 2021, this year, what would your advice be to them? Any different to before? Is there any changes to that?
I think just speak to advisor. There's a lot of good qualified advisors that can give a full options review in terms of trade sales, private equity, EOTs, buyouts, phased exits. There's lots of options available in this timing. So for most owners, when they're looking at something, or even if you're a management team thinking of buying the business, there's options available. So for the owners out there, you've most likely got a window, as long as they don't change the taxes in March, to actually prepare a transaction and execute it between the summer and the back end of the year. And that's quite appealing, I think, for some. It gives them time to recover their business after COVID. And then on the flip side, if you look at the management teams, the amount of funding out there is at an all-time high. Private equity are trying to find the best-in-class businesses and find the best management teams. So if you're out there and you want to roll out a business plan and acquire a business, the funding is there. It's just timing. I think if they change all the tax rates next year, that will really reduce the level of deals and people that want to sell, because it could be losing another 20-30% of the value on the table. So I think that the key message is speak to an advisor, get an idea, build that relationship, get a good understanding of what information is needed, what preparation, what planning is needed, how it impacts them, how it impacts the seller, and how the process works. And if you can pull all that together, there is enough time to transact this year and get deals away. And then you hopefully, as long as they don't change the tax rates, like I said, in March this year, which I don't think they will, you're clear to get through, because I think there's a good chance they will change them next year. So we've got about a 12-month window to do things, but there's enough time. I think the key message is there's enough time to plan, execute, and there's a lot of activity. So that's the positive.
Okay. Roy, what would your advice be?
I think it's still a good time to sell. I think it depends on, I guess, how well you've managed your business is managed through the pandemic. I like to get in front, as Adam will, I like to get in front of business owners and talk to them about all their options, because sometimes the default is trade sale and you end up at MBO. I mean, one of the transactions I'm working on right now, it started as a trade sale because the owner said, I want almost all of my cash out up front, no deferred. It was towards an MBO, which was going to be 50% funded by debt, 50% deferred. And now he's doing a wholly deferred sale to an EOT. So that client has gone on a journey with me. And I asked all the right questions at the start, but he had to go on that journey himself to come out at the end to decide that actually he was happy to do a wholly deferred deal selling to his employees rather than a full sale to trade. So I think my message to owner managers thinking of selling in 2021 is have these conversations with the likes of me and Adam, understand all of your options, allow us to educate, business owners, put all of them on the table. And I'm not a pressure salesperson, so I want people to work out what's right for them, and I'll put, the amount of time we invest into prospects. It's not wasted time into prospects to just help people make that decision, because once they start that journey with us, it is a long and tough process. And what you want to make sure is it's the right journey and it's the right process for them. But yeah, and I wouldn't be put off selling in 2021. You just got to understand, the value drivers of your business, the risks attached, and that said, you can do the best sale process in the world, and then find that the perfect buyer is struggling themselves. So you can't control everything, but I'd still press ahead, and especially with the threat of CGT going up.
Okay. And Roy, more specifically, I suppose there are some sectors that have really had a tough time that we all know over this pandemic. So, for example, how will sectors like leisure and travel be impacted from an M&A perspective once things get back to normal?
Well, I think there'll be winners and losers. There'll be businesses that are clinging on and will survive, and they'll come out the other side. And then, you know, as lockdown is released, we'll all want to travel and we'll all want to hit hospitality, and they'll have a boom time, and then it'll settle down. There's probably some, there'll be, you're seeing it on the high street now, you know, some very opportunistic purchasers who are cash rich, who are picking up assets cheap, or with the likes of Debenhams, obviously not picking up the physical assets, but just picking up the intellectual property. I think for those owners in those sectors who do get through, unfortunately, we just so happen not to, as a firm, not to have big exposure to retail or hospitality or leisure. So we've not seen many casualties. But I suppose my concern for some of those businesses is that to get through this process, they will have taken on a lot of debt or depleted their balance sheet and their cash reserves. And so I suppose if they were contemplating a sale at a certain value, it might be a struggle for that business owner to actually get what they perhaps were contemplating getting. And then does that mean that they can accept perhaps a lower price, or do they have to reset their timescale, you know, and start to build the business back up? So I suppose there'll certainly be some distressed M&A activity, but for some business owners, much as they might want to sell, they may not feel that they can afford to sell. So yeah, I think it'll be a sort of a mixed bag in that sector. And as I say, we're not deep in that sector at all. But I think you saw with share prices probably pre-Christmas, back end of last year. You know, it doesn't take much good news to significantly inflate the share price of a business in this sector, whether it's the airline sector, and it doesn't take much to send it the other way. So it's still fragile, and I keep coming back to this. Once we get back to normality, it'll be easier to assess. I just don't know, you know. Hopefully, I dare say it. Hopefully, it'll be back to normal. But I'm probably being a bit optimistic there.
Adam, what about yourself?
Again, echoing what Roy said, in terms of a lot of people out there in the market that are saying the same things. It's just the uncertainty. No one knows. You hope it does recover, but it'll take time to recover. And when it does recover, what does the recovery position look like? No one knows. It's tough for some sectors. It's really tough. Likewise, for some other sectors, they've had just boom years. So it just shows you the impact of coronavirus and actually how it impacts different businesses. I think it does change the thoughts of people that have been impacted negatively, and their funding and having headroom and having cash and having the visibility and forecasts, all that type of good stuff, just to give some reassurance to themselves and the visibility. But some businesses obviously are in really, really tough positions because you just can't carry on if there's no top line. So yeah, it's a difficult one. A lot of the businesses we've worked with, I mean, we've completed 3 deals over lockdown, a sale, a refinance, and a buyout. But so one of all three. But all of them are slightly different, and they've all got their own different types of structures and their own challenges and their own opportunities. So it's yeah, I think it's like your question, Lawrence. It's really driven around just certain sectors that have been impacted much harder than others, and just hope they've got the money and the planning in just to get them through and just get to this position where hopefully it will be the summer and things get back to normal. So it's just about surviving for the worst case. Okay.
And Adam, I know we've touched on this briefly before, but what's your view on how valuations will be impacted in the coming 12 months?
For what we're seeing, they haven't really been impacted hugely. Buyouts and debt buyouts pretty much have a sort of a ceiling of how much debt can be raised. So there's always going to be an element of deferred with most debt buyouts. It's very rare you can actually fund a deal purely on debt. But for some of the sectors that have larger multiples, we're actually running processes and achieving what we think we should be getting. But again, it's down to the sectors where they're not impacted. So you might have robust cash flows, a well-spread customer base, you've got contracted income, and it's a pretty sturdy business. So I think again it's sector related, but from our view of the deals we're working on, valuations haven't been massively impacted, but they're all businesses that are pretty strong. I think just sort of touching on Roy's point earlier, which was about getting back to that underlying earnings position, sustainable EBITDA, and removing the one-off bits is the key, because anyone looking to buy a business is going to look at what is the core business, not just a peak or trough. So being able to demonstrate that and communicate that as part of the process if you're going through a transaction will be huge. But also I think it needs time. So if a business has been distressed and needs a period to come back up, it will need a time to get back up to that core business before it can then achieve the valuation multiple it was looking at probably pre-COVID. So it's a range. It really comes down to sectors, but there's a lot of trade activity in some sectors, and there's a lot of private equity money that is trying to find good homes. So that there is opportunities there. It's just I think timing for the individual business, timing for the individual sector, and then looking at the buyer pools, because again, like Roy said, you can have the best business in the world. Your business might be doing really well, but if all the buyers aren't doing well, it's quite tough. So it's a combination of three. It's not an easy process, but it just needs to be managed. But part of what we do at Keystone, and I'm sure Roy's the same, and most good advisors will do this, is go through a detailed review of valuation metrics, who's buying, what they're buying, and then more importantly, what they look for. So we have in our presentation, we have a slide dedicated to each individual type, whether it be trade, private equity, or debt buyouts, and all of them have got a slightly different focus on what they look for and why they're looking for those types of characteristics. So part of our process in helping businesses become exit ready and the pre-transaction process is making sure you can qualify those internally, so you can position the business to the best chance of success and not be challenged. So again, some of those are going to impact valuation metrics. So again, if you can assess those at the start and look at the ways to mitigate those risks, you can present it better. But yeah, I think that the general summary is our view, it's not massively impacting, but we are dealing with businesses and working with businesses that have traded really well through it.
Okay. And Roy, you the same on valuations?
Yeah, I think this. Yeah, as mentioned earlier, I think the struggle potentially will be around different parties' views on what maintainable EBIT is, or EBITDA. You know, is it pre-pandemic? You know, is it post? Have you been artificially had inflated results during the pandemic? And I think that I think sometimes sometimes a business owner will genuinely believe their business is worth an amount, and certainly in this current climate, if a trade buyer can't get there, then it's entirely possible that potentially, if the vendor's flexible enough, is maybe flips to a deferred type of deal with a management team, where the vendor gets the amount they want, but they wait for it. And in effect, if there's a management team there who believes in the business and is capable of delivering the business, and perhaps they're not being asked to take a huge risk if the funding of it is largely external debt and deferred, then we sometimes can find a way to get to the right value and it be fair and balanced for all parties by doing an internal deal rather than a deal with trade. So that also kind of plays into this. You know, if you've got a fairly short window and you want to kind of capitalize, you want to crystallize your capital gains position. That's perhaps sometimes where sort of those management-led deferred deals can be a win-win for both parties. So, but yeah, I think the valuation discussions are always challenging, and might even be more challenging just given the very mixed picture that we've got, good and bad.
Okay, right. And staying with you, Roy, because of this mixed picture, I suppose, do you think there'll be more distressed M&A in 2021?
I think there's got to be. As I say, we don't really spend too much time at that end of the marketplace, but the amounts. I mean, I think everyone thought a lot of the support was going to end in September, October. If you cast our minds back, CBILS was due to end. Coronavirus Business Interruption Loan Scheme and Bounce Back Loan was due to end in September, then November, then January, and now March. I don't know whether there's going to be a further extension to that or the renaming of it or something. A furlough was going to end in September, October. I think that's now running to April. So we are in a very artificial place right now, where businesses are being given, in my view, you know, rightly the level of support that they need, but it is very artificial, and until we get out of that, I think once we get out of that, then we will we'll start to see casualties. But I guess the government have got to sort of balance the path to walk along, because if they pull the plug too early on all of these support mechanisms, the raft of casualties will be enormous, and they will need many of these businesses to come out of the other side intact. So government can't afford to have too many casualties, and we can't as a country. I suppose you look at examples like Debenhams, and you'd say, well, actually, Debenhams was a business model which was crying out for change. And I suppose if you go back to Woolworths and you go back to BHS, those casualties probably had to happen because the business hadn't evolved in time. I suppose what this pandemic's done is made everyone. It's fast forwarded 5 years, so I guess it's made the high street. The high street is suffering massively because it's the gradual evolution has really accelerated. We've got 5 offices. We were thinking of taking on some more office space in Birmingham. We've paused that because there's a new way of working for us. So I think coming back to your question, distressed M&A is going to happen. The government are just continuing to give support to try and hold off that day when the plug is pulled on a lot of businesses, and they just don't want those headlines, and we don't really want it as a country.
Brilliant. And Adam, how about yourself?
I think again, Roy's done a good summary there. There's only so much funding available. There will come a point where businesses got to return to normal, and you hope that the businesses that are struggling have got the headroom and the cash flows to get them through. But unfortunately, I think some businesses won't make it just because it will take longer than the cash flow and the headroom they've got. So yeah, I think it will drive M&A, and I think it will drive a lot of consolidation. And I think I know there's a lot of different PE firms that are more distressed M&A that are sort of waiting to look at opportunities of consolidation plays. So I think there will be, but we track a lot of businesses at Keystone on our databases. So we are starting to see some of the accounts now come through at a file at company's house that are showing the impact. And of course, there is a bit of a time delay, but unfortunately, some of the performance is sort of night and day different from being really profitable the year before to now where they are in a distressed period and they've actually got a CBILS loan to help them fund. So unfortunately, yeah, I just don't see a way out of it unless the government puts through another series of loans and support schemes to help them through, because it's not something you can just turn on and turn a business around overnight. There's fixed cost base and the delivery of the operational capacity, which you've got to fund and keep in place. So yeah, I think it's going to be challenging, unfortunately.
Yeah. And Adam, what about the banks? Will they continue to fund transactions this year?
So my view on the actual high street banks at the moment is that not a lot of them are lending at the moment. A lot of them are, I think the term in the industry is put the foot on the ball and just assess what's going on. Where I think there is debt funding out there is the alternative debt funders that are filling that gap in the market. So got a bit of a different risk appetite. They will look to lend. They will look to lend with structures that are a bit more flexible, so interest only parts rather than all capital and interest. In addition to, there's going to be a lot of opportunities for businesses that need more than a bank. And again, there's the ABL worlds and the alternative cash flow lenders out there that are quite active. So I think there's definitely debt funding out there. It just comes down to what's the need for it. There is transaction funding for MBOs, MBIs, and acquisitions. There is also working capital, growth capital, but also I'd sort of caveat with there's equity funding as well. Sometimes to deliver your plan, you don't want to sell the business and you don't want to sell majority to a private equity firm, but selling some equity and bringing someone else in to help grow the business might work for the right situation. So I think there's a wide range of options out there, and the banks probably, in my opinion, at the moment, are probably towards the back outside the CBILS loans, just because a lot of the banks we speak to are just waiting for things to return to normal and give it a bit of time.
Okay. And Roy, anything to add on that on the banks, or even what the alternatives are if the banks aren't?
No, I echo what Adam said about High Street Bank. They've done a decent job of looking after the client base through the use of CBILS, but haven't been that interested in taking on any significant risk on taking on board new clients. Whereas you've got the likes of these challenger banks, whether it's Shawbrook or your ThinCats or Oak North. There's a number of lenders out there who are prepared to take more risk. They will charge a higher rate of interest, and then you've got organisations like Frontier Development Capital, mezzanine finance provider, where you're not paying the capital back along the way, so it's easier on the cash flow. And sometimes when I present these options to clients, they'll say, oh, that interest rate at 8 or 9 or 10% is expensive. And you have to remind them, compared to what? Because if they really need the cash and the high street lender isn't prepared to lend, and the alternative is equity, then maybe 8 to 10% interest isn't that expensive, particularly if it's a relatively short period of time as well. So I'm pleased that there's a raft of alternative lenders out there looking to fill the gap which the high street banks have temporarily created by perhaps just reining in their appetites.
Okay. And so carrying on from that, Roy, really, so we mentioned private equity briefly, and they've usually got a fairly good appetite for it. What's their appetite to invest likely to be this year then?
I think strong, because they've always, regardless of what the world looks like, they've always got cash typically. Some are doing it off bank balance sheets, and some are doing it from fundraisings from local authorities and pension funds. I think as ever, you'll get the really good deals will get really aggressively chased by PE because they'll all want to do the same deal. I think the challenge that I see is raising sub 2 or sub 3 million of equity, because that landscape is quite scarce. So it's raising 5 or 10 for the right kind of business isn't really a problem at all. It's raising those lower amounts. And I was speaking with the British Business Bank last week. They were canvassing me on kind of what the funding market looks like and where could be helping. And I think kind of that equity investing at that lower level would be really welcome, but there's probably too many investors out there who have tried and failed to make returns at that level. So whether or not there needs to be something akin to British BGF, that was formed back in 2008-9 at the back of the recession, and have done really well. And I shouldn't describe those, but I describe them as the least worst private equity, because they are private equity, but the friendly private equity. And I can see them doing a lot of deals, because they like to partly cash out shareholders and put money into to grow businesses. And I can see that there'll be lots of businesses out there where business owners need to strengthen the balance sheet, but also have had such a torrid time that taking some cash out and selling some shares might be a happy medium. So I think there will be opportunities for your mainstream PE and for the likes of BGF. So I'm not concerned around there being a shortage of funds. I think the challenge is always to present the best story you can to the right pool of funders to find solutions for our clients. So I'm not too concerned about shortage of funding, other than perhaps that 2 to 3 million, up to 2-3 million of equity, but that's not driven by this pandemic. That's just because the market hasn't really catered for that level of equity funding.
Brilliant, guys. Thank you so much for that. That kind of brings to a close the formal questions, but I've got some from the audience. So if I try and go through as many as I can now. If I start with you, Roy, this kind of just carries on from what we were just talking about. You may have answered it or not, but from somebody called Martin, does the panel expect funding to be available in the marketplace? And do you expect that multiples for deal calculations will fall in value due to COVID?
So now I think on leveraged lending, so where let's say the business hasn't got lots of assets and we're raising finance on a multiple of EBITDA, that multiple may come down a bit. So perhaps, whereas I might have hoped to be able to get 3.5 times EBITDA multiple, it might be nearer 2.5 times, which I suppose then naturally, if there's an MBO structure, can have an impact on valuation multiples, because it can have an impact on valuation multiples. Alternatively, the vendor, if selling to the management team, just takes more deferred. So I'm not sure it's necessarily going to impact on it. It probably will impact on valuations a little bit, just because anyone who's needing to raise finance might not be able to raise quite as much finance as they want. And the multiple of EBITDA that we're able to borrow probably comes down a little bit as well.
Okay. Adam, anything to add on that?
No, not really. I think the other thing I would say is you just got to take on board where the business is now and what that EBITDA is. That's the hardest thing. What is the EBITDA? You put in the lending multiple on. Again, it might need 6 months, but in 6 months, a transaction normally takes 6 months. So if you're looking to do something, can you plan it and get it ready for 6 months' time, and the EBITDA goes up, that might be the difference between doing the deal and not doing the deal. So again, coming back to preparation, speak to advisors, get an understanding how it all works. You can sort of roadmap where you want to get to, and is it possible?
Okay, brilliant. And one from Sid. Adam, I'll start with yourself on this one. Do you see the distressed M&A market being a good source for buy-side opportunities over the next few years?
I think so, because as I sort of touched on earlier, I don't think all businesses will recover. So it's sector specific, and it's actually going to be around timing of when businesses run out of cash and actually can't continue anymore. But I think unfortunately there is going to be a smaller businesses that just want to get out and consolidate at distressed prices because they haven't recovered. There's going to be businesses that go bust, and they're going to be buying assets and contracts and customers out of administration. And I think you're going to find a lot of people are more open to potentially merging businesses and sharing some overhead and making it work as they recover. So absolutely, for Sid's question, I'd expect there will be more and more M&A in the distressed market. And going on what we have with our database, we have daily lists of businesses that are either doing really well, making a lot of cash, or businesses that aren't doing very well and struggling. So we have that emailed to us every day from Keystone. We've invested in our research origination. It's one of the key things that drives a lot of our conversations when we speak to companies directly. And we're seeing like I said earlier on, some of the businesses are starting to come through now with distressed accounts, and I'd imagine that's going to continue to the point of which when all the government support stops, unfortunately, there'll be more businesses that go through administration and actually look at accelerated M&A processes.
Okay, brilliant. Anything to add on that, Roy? It's fairly concise.
No, I think Adam's covered it well.
Yeah, no. Roy, so if I ask you, a question from Giovanni asks, is there a danger that COVID and the prospect of tax changes lead to too many companies up for sale? And what advice can you give to get the timing right?
So there could be a flood of, I suppose, there's all those sales perhaps which business owners wanted to take place last year which haven't. And then there'll be the sales which the people perhaps planning in 22 or 23 that they brought forward. So could have a glut of sales. Because from my perspective, then it means trying to pick the right ones to advise on. But it's just remind me of the second part of the question.
So what advice can you give to get the timing right?
So I suppose I can't ignore the threat of a tax rise, but I suppose I always start from the position of what does a business owner want to achieve? When do they want to be? When's the last day they want to be in the business? Because often working back from that, if the last time they ever want to set foot in that business is in 2 years' time, and they're a fairly key part of that business, and working back, there might be a 6-month transition period post-completion, and there might be a 9 to 12-month transaction process. Kind of work out, you've got to start pretty quickly in terms of planning for that. So undoubtedly there'll be a rush of people who come to me and say, post the budget, they'll be saying, I want to sell. I kind of always want to just pause and just properly understand them personally, the business, where it's going, what the business could be worth now or in 3 years' time, and talk all of that. Have they got a management team that could buy the business, and understand all of that rather than rush to make decisions. It might be then that we all conclude that a sale process started now is the correct thing to do. But I think because of the investment myself and Adam put into a process, and the fact that our rewards are often largely linked to the success of the transaction, we cannot afford to just have a knee-jerk reaction to jump into a process. We've got to be absolutely certain it's right for the client. So we've just got to do a job of educating and vetting the inquiries, so that we take people through a process who actually want, where it's right to do so now. And for many people it will, and for many people, it might be in a year or two's time.
Brilliant. Adam, anything to add to that?
No, I think that's a really good summary.
Brilliant. And also, lastly, I think I've got one from Jeremy here, which I'll ask Roy first, because I know you've mentioned it before, if you don't mind. But does an EOT deal have any downside?
So having said we'll have completed 3 in 12 months, I'm still a little bit sceptical of EOTs, and the reason I give a balanced view with my clients. So once a business, as far as I can tell, because the legislation came in 2014, and whilst there's been examples like John Lewis around for a long time of employee-owned structures, this drive to EOTs has been in the last few years and quite a lot in the last 12 months. My concern is that it's very difficult, as far as I can see, for a company to leave an EOT structure. And I suppose in many ways that's the point. A business owner sells to an EOT and then it is owned by the employees. My concern is that in years to come, if you haven't got a properly incentivized management team, that business might lose what was special about it. It may start to languish and not be as good a business as it once was, particularly when the owners exited. And then in any other environment, typically maybe a privately owned company would come along and purchase that company and give it what it needs. It injects capital or injects fresh ideas. But as far as I can tell, for the trustees of the EOT, if they were to receive an offer for the business, have to make a decision in the interest of all employees. And two things. One is, if there's any cost cutting involved, then that's not necessarily by the acquirer. That's not in the interest of all employees. And again, I suppose on the positive side, if you had a business which might be worth £10 million and has got 50 employees, and a buyer comes along and enriches every single employee by £200,000 each, is there a risk that those employees are going to not come back in the following day? So there's risks. So my biggest concerns around EOTs is perhaps in the future where they might benefit from being outside of that structure, and I'm not sure there's an easy exit route from it in the future.
Okay. Adam, same for you. Does an EOT deal have any downsides on your?
I think it's how you define what you want from your transaction, really. So Roy's made all the right points with some of the complications with EOTs. But if you're going to compare an EOT that is bare bones to a debt-only buyout, you'd still be able to take equity in the business going forward. So one of the qualifications we'll always sit and ask is, what are the requirements and how important is paying that tax and the money up front? Because if you've got a huge amount of cash on your balance sheet and you're adding that to the price and you're walking away with that not paying tax, sometimes the EOT could be seen to be a better deal. But as an alternative, and we pitch this as, and we've done quite a few of these type of deals where rather than have the deferred value left there, you will pay some tax, but you can structure it and mitigate the actual charge in the future down, which at the moment you can with family investment companies and other bits and bobs around a creative structure. That's all HMRC approved. But I think the key bit is if you have shares in a business, if in 5 years' time the same situation comes and the management team have got shares, you've done more what I've called of a partial transaction and stage process where you've had some money day one, you've had some money throughout the plan, but then you can actually sell it and there's no complications with selling it. EOTs, the biggest drawback, and is that whole point around selling it in the future and is selling it in the right thing for the employees. Because if you're an owner and have sold your business and you are owed money and it's sitting there on the balance sheet and someone makes that trade sale offer, as an owner who's sold the business, you actually say, well, yes, I want the trade sale to go through because it pays me off in full, but the trustees might be saying, well, actually, no, it's not the right thing for the business and it needs more time. So there's the conflict there. So it comes down to what we call the deliverable deal and looking at the different stages and how important is that money up front or the money over the 5 years. In addition to, if the business does really well and the management team grows in, you've still got some equity left over, you don't have to sell it. You can draw dividends out. You can use family investment companies, take that money out, reinvest it into property. There's lots of benefits for effectively debt-only buyouts and rolling the equity on as an alternative just to having zero tax. So again, the whole thing with the review is we get all the numbers and we'll go through the whole presentation and say, this is what it's worth, these are the transactions, these are the funders, these are the options, and then this is what it means for you and your business. I think only when you get to that level of detail, and we do that and get through all that detail as part of our process when we meet potential clients, you can actually reshape the deal. And one of the key bits I'll always ask the clients with is, if there's a white piece of paper and tell me what are the key requirements on your deal, and we'll always try and make the deal fit their requirements and go to what we can get with funding, HMRC clearance, and something in it for both the funder and the seller. You've got to be able to deliver across all fronts, and if you do that, you've normally got a good deal. So EOTs do have some of the limitation that your hands are tied. What I would say is debt-only buyouts, if that's the route you're going, the M&A sale isn't there, there's a lot more flexibility. So you're giving the tax benefits of paying no tax as to pay a bit of tax, but get a lot more flexibility. And again, it comes down to individual requirements.
Brilliant. Guys, thank you so much. That kind of brings everything to a close. All the questions are answered, so I appreciate it. To the audience, thank you so much for being here. I appreciate it. Look, if anybody needs to continue this chat with either Roy or Adam, feel free to contact them. They're both happy for you to contact them via LinkedIn. They're both on there, or their details are on their website. So Roy Farmer at Dains and Adam Rowlands at Keystone, thank you so much for today. Really appreciate it. And to the audience, obviously, a special thank you to you guys for logging on and listening to both Roy and Adam. Thank you so much. And this formally brings it to a close. Thank you very much.
Thanks, Lawrence.
Bye, gents. Thank you.
Bye.
Bye.